You're listening to Biotech Hangout, a live and unedited weekly discussion of all the latest news in our industry with a group of biotech insiders. I'm Daphne Zohar, and my co hosts today are Paul Matteis, Brian Skorney, Tim Opler, and Abe Ceesay. For more information about our hosts and guest speakers, or to listen to the most recent episode, please go to biotechhangout.com. Tim, you mentioned that investor sentiment is improving. Is the market beginning to settle in with the new administration, including RFK and some of the broader macro uncertainty around tariffs?
I think so. So if you go back to the JP Morgan healthcare conference, you know, we had a pretty good Monday, January the 13th, and the market went down. So the XBI was like trading around 86 and a half. The XBI since then has traded up pretty nicely. So it hit a high of 94.7. Today it's down a little bit, sort of around 92. So the market is up. And Paul and I, as he was saying, we're at this conference in Utah, so we had a ton of investors. So it was a nice opportunity to chat, with a variety of different types of hedge funds and long funds and sort of see where, the mood is. And Paul, I'd love to hear what your impressions are. Brian, what what you're hearing in the market. But I would just say that things were less negative. I hesitate to use the phrase positive, but things were like really negative at the start of January, and that seems to be shifting. And I ask people like, why? Why do you feel better about the market? A lot of people talked about RFK's confirmation hearing as being somewhat comforting, and also I think Trump is now talking about kind of pulling back a little bit on these tariffs. So it's more I would say carrying a big stick than actually using the stick. And I think there's also a sense that Trump is really committed to take interest rates down. So yesterday, he actually came out and said, I'd like to see the 10-year, actually not Trump, but the new Treasury Secretary said, I'd like to see the 10-year Treasury yield come down. So that's obviously very good news for biotech.
Yeah, so less negative is the new positive. Paul, do you have any comments, or Brian?
I mean, I think I don't know. Maybe a little bit less negative. I still feel like in my coverage, and I bet Skorney could echo this, or maybe not, that there's more like defensive investing than really wanting to take on risk in some of these beaten up, still super binary high science names, right? I mean, I feel like if I'm looking at the spectrum of beta or risk in my coverage, like there's still a lot of small companies that have interesting science but are more speculative, where it's harder to generate a lot of interest, and then I think just you have this Neurocrine trade down today, which is a little bit tough. I mean, I think that was a name that was well liked and maybe a little bit crowded and might have some sort of broader concerns on the payer Medicare side that people are talking about. But yeah, I mean, maybe it's not as bad as January. It's not as bad. And we've had some good news events too, and some successful financings on the back of those news events. So probably improving, but still feels like it's, I don't know, if you're indexing it to the past 5 years, below average. What do you think, Brian?
Yeah, I kind of agree with that sentiment too. Yeah, I definitely think it's more of a less negative situation, but coming from a basis where I think like Tuesday of JP Morgan, when we're on our second day of consecutive 2.5% down after some pretty sizable M&A, it was starting from a pretty negative base. So, I get a sense investors are like trying to keep their head down, trying to do a little bit more risk off. Obviously people still view catalysts as tradable events, but yeah, there's definitely like the more defensive plays you see. Dividend paying stocks, large caps are performing pretty well. And I mean, as much as we've been up since JPM, I mean, we're still, trailing the S&P by 12%. So, I don't know that we're looking at a positive sentiment. And look, we've talked about this a ton of times. But to Tim's point about the sort of de-escalation of tariffs on at least from what Trump is saying, there's just this massive sensitivity to the sector of, is there a chance the 10-year sees a steep incline in rates? And as we saw, maybe 14 months ago, there was this huge tailwind from the idea that we were going to see the 10-year decline. So, as much as that sort of macro trade is on, that, that seems to be a big sentiment driver for the market.
So if I listen to you guys and sort of listen to myself, I would say that I'm saying sentiment's gone from like a 2 out of 10 to like a 4 out of 10. Paul, I think you're saying like 2 to maybe 2.5. I don't know. And Brian, maybe a little better. Would you agree with that, or am I just being delusional?
Yeah, no, I think that, I mean, I would say maybe from a 1 to a 3 is how I'm different.
Yeah.
Yeah. And one of the issues we have right now is that the lack of generalist interest. And I want to come back to a conversation I was having with Tim yesterday. Tim, you mentioned that you're seeing a reemergence of wall cross pipes. And wall cross pipes were very much in vogue around a year ago. They concerned me at the time because they tend to preferentially advantage specialists. And last year, when we were seeing a bunch of these, I spoke to a couple of friends who are top tier specialist investors in biotech. And one of them said, and one of them was actually on the show, I won't mention his name because he's a friend. And one of them said, hey, it's my job to outperform the market, and I'll take any advantage I can over generalists. Generalists aren't my problem. I don't have to look out for them. I have to do better than them. And another felt that these practices, like the wall cross pipes, were borderline unethical and that the SEC should look into them. But he also admitted that he's not going to turn down an opportunity to see the data and participate. My question is whether these inside baseball types of deals hurt generalist interest in the sector and over the long term maybe hurt the performance also of the specialists. Love to hear from you first, Tim, and then from the others.
I mean, it's such an important question for our sector. I mean, the reality is that a lot of companies are able to access capital because of specialist investors. And if specialist investors say, hey, we want to do it with a pipe with this discount or this particular twist or turn, you know, that's the price of doing business. At a macro perspective, I do think that you have to worry about how, you know, specialists tends a preference. And, you know, the reality is generalists are not participating as much as one would like in our sector. I personally think that there are a set of relatively deep issues with how our sector works that are keeping generalists away, not the least of which is, you know, AI looks pretty shiny and you don't have to have a PhD to buy NVIDIA stock. But at some point, things are going to turn in our sector's direction. And I do think that we should think hard about business practice.
Does anybody else have comments on specifically wall cross pipes? Oh, sorry, go ahead, Tim. I think you cut out. I thought you were done.
Oh yeah, no, I was just saying that that's my view, and you know, it's a feature of our sector, but also has its downsides.
Yeah.
I mean, I guess I would say, jumping in here, that I feel like generalists are so far from being involved in the type of stocks that are wall cross pipes. It's not even an issue right now, right? Like I just feel
I
like
totally agree.
generalists are you know, they're maybe you could get them into like a Regeneron or Amgen, but you know, getting them into like 2 billion or less market cap companies, I mean, we are so far away from grabbing their interest there that I don't think it's dissuading them at all.
And what about other practices? Abe, it looks like you want to comment.
Yeah, I was just going to comment, as an operator, and Daphne, I'd love to hear your thoughts on this too. I think in markets like we're, operating in today and trying to raise capital, I do believe that optionality is so important. So although, these wall cross pipes may somewhat, divide or segment the types of investors that can be involved and will be involved. I think the reality of the situation is for, raising capital in this environment, you have to preserve that optionality. It's just kind of like the world we live in right now. So it is not probably appealing to all investors, but I think as an operator, you have to kind of, as I said, really preserve that optionality.
Yeah, and I think the question is, what does it take to get generalists to come back into biotech, into the smaller biotechs, the sub 2 billion companies? And it's such a complex set of, first of all, data. You have to really understand the data. You have to understand the catalysts. And I think there's so much complexity in the industry that it seems like the decks are sort of stacked against any generalist investor. So I don't really know if I have an answer to that. I do agree with you that it's important to have options as an operator, to be able to have options for how you fundraise. So I think this is more of a question more broadly about how do we get generalists to come back into the sector. And obviously M&A is one of those. And I'd love to actually go back again to Tim to talk about big pharma earnings and what they were saying about M&A.
Yeah, and Daphne, before touching on that, you know, I've often thought that there are just way too many companies that announce like a complete response letter in phase three, and like investors are all surprised. And so biotech companies that are public are subject to all sorts of SEC disclosure requirements that are probably not that relevant to what investors actually care about. And so, you know, so many companies, when you go in and you do your M&A diligence, you discover that there's something pretty unpleasant that got said to them by the FDA in correspondence that they're just not disclosing to investors. So the quality of disclosure about what really matters, which is how are you doing on data, how's your science, and how are you doing with the FDA, quality of disclosure is actually not that good in our sector. And if there's one thing that I think could improve generalist access, it would be to take away some of the edge that specialists have. And the specialist edge is figuring out what's actually going on, get on the phone and do doctor calls, you know, go sniff around on clinical sites and find out if the company is telling the truth or not. And while that's great if you're a hedge fund, I do think it tends to work against the overall story in this sector. I don't know if others share that view, but the quality of disclosure, I think, could be better.
I think like Tim, so it's interesting, right? Like I think I've had some interesting conversations with this about just, regulating the sector and regulating management commentary in the sector. And I think the challenge is that there's just so much subjectivity in our sector, right? And like a lot of the exercise in vetting a company is vetting not just your trust in management, but your management's interpretation of the FDA or interpretation of clinical data and whether X or Y is cherry picked, and you see in this sector, right? Like we feel like there's many times where companies have said something that's misleading and there's no consequence to it because ultimately I think interpretation of data, interpretation of science, interpretation of regulatory feedback is often super duper subjective. I mean, I think like that's also a challenge too. Like when I talk to the occasional generalist who's looking at like a mid-cap biotech company and wants 1,000-foot view of it, like the reality is like the controversies that are driving the stock might be related to some sort of esoteric biomarker and whether it truly does or doesn't correlate with progression as well as the company's saying. And I just think these types of minutia are, again, like they're so subjective that it's like really really hard. Like what Skorney was saying, we're so far away from generalists doing these sub 2 billion market cap companies. I mean, to some extent, like maybe that's a good thing. I mean, I don't know. We're as like analysts, when we recommend names, we're supposed to think about like suitability. I'm not saying like all mid cap biotech should be off limits to generalists, but if you go back to like 2015, where there was tons of generalist interest in just things like gene therapy as a concept, right? It's like some of the people buying those stocks probably really didn't understand their true risks, right? And like that's not a good thing either because look at the outcomes there.
Yeah, I mean, I would also echo that and say, look, I think it's like generalist interest largely becomes cyclical, right? And there's an element of like FOMO uh, when the sector really starts working, that's what will drive generalist interest, right? I think it's a sector that has been down on its luck for 5 years now, and without sort of an inflection and launches that will pay out in big share price increases or big innovations that result in big share price increases. Generals could just afford to not be involved. Only when it starts outperforming do they have to be involved, right? So it's really a bit of a FOMO trade, and it's really only when you get that outperformance do you sort of force that interest to occur.
I think that's right. And so, Daphne, coming back to your other questions, sort of what's going on with pharma. So we are going through pharma earnings, and you might recall that when J&J did their earnings, they're usually the first out of the chute. They said, "Hey, Intra-Cellular was kind of like a one-off. Don't expect us to do other $10 billion deals. And the commentary at the JP Morgan conference from the various large pharmas was, yeah, we'll be doing M&A this year, but think of more like smaller add-on type deals. So it was very electrifying, I think, when we were starting to hear much more open discussions to larger M&A coming out during the earnings period. Pfizer said that they've got $10 billion plus to do M&A this year, so that was a surprise to me. Merck has also been talking up, their capacity to do M&A, as have a number of other companies. And so I do think that the M&A outlook continues to look positive. I will say, I'm a banker, one of many bankers, so I only see part of what's going on in the market. But I will say, just from the the less visible pipeline that we're seeing, both our own but also from other groups, it's going to be a strong year for M&A in 2025, and so that should be a big positive for the market, on top of kind of what's going on the political slash macro side.
Yeah, and you mentioned Intracellular, and that would be the largest acquisition of a biotech company since the Karuna BMS deal, and the fourth multi-billion-dollar acquisition of a CNS drug developer in the last year or so. So let's actually talk about some CNS news that we had this week. Paul, you can start with GH Research, which met its primary endpoints in a phase 2b trial for a short-acting psychedelic drug in treatment-resistant depression. Take us through the data.
Yeah, sure. Thanks, Daphne. So GH announced data from their phase 2b study. It wasn't a huge trial. It was 81 patients, but it was randomized, placebo-controlled. They evaluated patients on an 8-day primary endpoint and then also looked at durability and redosing out to 6 months. I mean, if you take a step back, like I think the psychedelic space has come an extremely long way in 5 years, right? I mean, I think 5 years ago, right, there was still uncertainty around the FDA path of these things, right? We did have Spravato get approved. Some of the early companies had less experienced management teams. I think we're seeing more experienced drug developers join the C-suites of these companies. And I think, and then also we've had data now from multiple randomized controlled trials, whereas a lot of the historical data was open label or cases or anecdotes. And so for GH, I mean, this was a really big data set because we only had open label data before it. Their difference from placebo on the MADRS, the approvable endpoint in depression, was a whopping 15 to 16 points. And, usually companies are powering phase 3 studies in this space for like 3 points. And then on the durability side, I mean, they showed that redosing looks to appear safe and they can get this pretty high remission rate over the long term. Their durability or their treatment paradigm in the open label was different than many studies I've seen, because I think a lot of companies are kind of conscientious of not overdoing it on the redosing and trying to make sure that a patient has truly relapsed. So sometimes you might have a restriction where you can't redose until there's a depressive episode for 4 to 6 weeks. And, in this paradigm, right, I'm not saying they weren't redosing twice in a week, but at their scheduled visits, if the patient wasn't in remission, they just redose, right? Which was kind of a bold move. And so I think overall the data are really impressive. The biggest caveats here, which I know, Daphne, you wanted to opine on, and it's interesting to hear your perspective, are one, there was, I think pretty obvious functional unblinding in this study, given that the placebo arm just didn't improve at all. I mean, this is a fact, I think, of a lot of these psychedelic studies, but this was a more extreme example with the lack of placebo response. And then the second piece is GH is ultimately changing the medical device that's administering this in future trials, and that always introduces risk, right? I mean, they have a clinical hold with the FDA on this device that they think they're going to resolve, but I think investors are going to want to see pharmacokinetic data that shows that you can really bridge these data into the next study. But broadly speaking, our view on psychedelics, I think, has improved a lot, notwithstanding the factors that I mentioned at the outset. Spravato, J&J's esketamine drug, requires a 2-hour patient visit every other week. The drug only worked in 2 out of 4 randomized controlled studies, and yet it's annualizing at $1.2 billion, right? So I think that really lays the framework for a real commercial paradigm for this space, and there's reasons to be excited. Daphne, anything to add on your end?
Yeah, a few things. So first of all, when you have a drug approved for depression, these are among the most, widely prescribed and commercially successful drugs of all time, and that's because of the huge unmet need. And so I think that that is it's very important to have these drugs. I think also the general sentiment towards psychedelics has improved quite substantially now that we're seeing randomized controlled studies and, like you said, strong management teams. They do have this issue of functional unblinding, and also commercially having to have sort of a shaman there while the patient is having a psychedelic trip can have commercial implications. But as we're seeing, those are, you're still able to get some great commercial traction. The point of functional unblinding, I think, is only one of many challenges in neuropsych drug development. So even drugs that don't have a functional unblinding issue have other nuances that one really needs a lot of experience and scar tissue in this field to manage well. Like, for example, some issues include challenges with patient selection, and there are ways to manage this by selecting the right sites, very closely scrutinizing patient enrollment, excluding patients that have big improvements from screening to baseline, excluding patients that might have adjustment disorder. For example, this was a big issue during COVID, where patients may have been enrolled that were reacting to the pandemic rather than having proper MDD. A range of other ways to manage patient selection, and there are some intriguing biomarkers in development, which I think will be very helpful once they're validated. And then another big issue generally is that of high placebo responses. Obviously, we didn't see that here in the GH research study. And those can be managed by limiting assessments and other patient interactions, or having only one active dose. So there isn't an inflated expectation that the patient is highly likely to be on active. And of course, that's assuming that you don't have to deal with hallucinations or other major unblinding issues and things like that. So I think that it's a very nuanced place. It requires experience, but on the other side of it, lots of M&A interest and successful launches when you see them. So I'm not sure. Actually, I'd love to hear from Abe, and also maybe Abe, you can tell us about the Axsome Therapeutics migraine drug approval and what you think about shorting the launch thesis in
Yeah.
this case, given Biohaven.
Yeah. So, good news from Axsome, AXS07 brand names, Simbravo was approved. I think a couple interesting things here. One, we can talk about, the aspects of the migraine market, where the opportunity might be here, but also, it's always great to see organizations overcome CRLs. I think it was mentioned earlier in the discussion. We know that drug development is not a linear process. We also know that the NDA submission is not a linear process. So the fact that although this seems to what it was just a CMC issue, it's always great to see organizations be able to overcome those things and ultimately get products to patients. My view on the migraine market is it is still a large and underserved market. We saw kind of the emergence of CGRPs, and really CGRPs being able to really provide patients with added benefit over triptans. But it still seems to be that CGRPs aren't meeting the needs for all patients, and I think that's been pretty clear. Although there has been, some successful launches, such as the Biohaven launch, as you mentioned, Daphne. One of the dynamics that I think is really interesting here, in my opinion, when you look at the Axsome kind of case study, is I do think that this market opportunity will be somewhat kind of an evolutionary tale, just given that the data that they have based on the approval and then the data that might be coming later this year. So one of the challenges is going to be the data set. I think today really supports for those patients that are going to be unresponsive to triptans. Triptans, as we know, aren't great drugs. And I do think that there's a payer dynamic that the market is going to wait to see how access will evolve for a drug for most patients that have to step through triptans. But the other data set that I think will be interesting will be the data set that I believe is coming at the end of this year, that is looking at patients that are more unresponsive to CGRPs, which I think could be, an incremental shift, not only in terms of how payers may view this compound, but also how it may open up kind of the overall kind of clinical utility and patient opportunity for the compound as well. So a lot to be seen, I think, here over the coming months. I think that yes, there is a general sentiment, especially as I think about the dynamics around this launch, that this will be kind of a show me launch from an investor perspective, knowing that payer dynamics are going to be a major gatekeeper to the uptake of this drug, given the fact that the prescribing universe is relatively broad in migraine. This will be something, in my opinion, that is going to be kind of a show me launch. And as I said, might also kind of have two stages of evolution, the data set that ultimately allowed for the drug to be approved, but another data set that's coming at the end of this year that may open up the market further for patients that are unresponsive to CGRPs. Would love to hear, others' thoughts on this. Paul, I know you know this space relatively well, but any other thoughts would be open to.
I mean, migraine's a huge market. It's just one that's very capital intensive, right? So I don't know the amount of resources that Axsome's putting into this relative to Bio. I mean, Biohaven's spend was really substantial, right? And there was a lot of tailwinds for CGRPs, right, with 5 companies in that category. So it's probably something that might be. I don't have skin in the game there. I don't cover the stock, but it's a big market. And Pfizer's bet on Biohaven was getting this market more into primary care, and so huge opportunity, but one that requires a lot of muscle, I think, to do right.
Brian, did you want to say more about Neurocrine? You started to touch on it in the beginning.
Well, I think Paul was talking about Neurocrine. I hadn't mentioned
Oh,
Neurocrine, but I'm happy to
yeah.
jump in too. But I'll let Paul take it. We both cover it, but
Yeah,
I'll let
Skorney, I want
Yeah,
to hear
Paul.
both
your
of you.
thoughts, but because I think I mean, Neurocrine yesterday. So Neurocrine yesterday really surprised people because they missed numbers, and Neurocrine is a company that has done a great job of consistently beating numbers and consistently guiding conservatively and beating numbers, and then they guided 2025 below consensus, and this is for their drug Ingrezza for tardive dyskinesia, which is ultimately an enormous success story, right? I mean, I think when this drug launched, people thought it was a $700 million drug or something, and it's going to sell 2.5 billion at the low end of guidance this year. So you got to put it into some perspective, but this is also a stock that had been kind of a safe haven growth stock, right, in a tough market where it's a mid cap, it's profitable. They're launching another drug for a rare disease that should go relatively well. And so, in the context of this, I think that there's actually just a broader conversation here that I love to hear other people's perspectives on, because there's the Neurocrine specific factors with this drug, right, where they've got greater competition from Teva. But I think one thing that's interesting that we put in our note after catching up with the management team is what they're seeing is that they're seeing greater payer pushback without really a significant change in contracting dynamics in their market. And so what I mean by that is that in this tardive dyskinesia market, Ingrezza is on some formularies, it's not on other formularies. And that's been a specific or an intentional strategy to not over contract and over give back on price. And I think historically, I mean, the results tell you that's worked out really well for Neurocrine. And it hasn't been an issue. But more recently, and I think we don't know exactly when this trend started, but let's say sometime in 2024, plans have been pushing back more. Instead of kind of making a physician jump through more hoops, there have been a greater number of outright no's, right? And I would imagine, given the guide and given that it's February, that this continued significantly into January. And so I think the implications of that for the sector broadly are sort of up for debate. I mean, maybe it's something specific to this category. Maybe TD just hit a tipping point where it's a $4 billion class, and that's a lot more than payers had really bargained for. Or it could be something related to small molecules, and I think that this could kind of be an indication of a broader Medicare Part D issue where these highly expensive specialty drugs for the non-Medicare Advantage patients, there's much greater cost sharing or payer liability under the IRA, and what that kind of means for a lot of these drugs broadly, I think is an open question, right? How are payers going to manage that, right? And they're probably going to manage it in different cases differently. This is something, totally different area that we talk about a lot with investors in the TTR space with BridgeBio, Pfizer, and Alnylam. But the print for Neurocrine kind of put my radar up a little bit more for this, right? Because for those who don't know, under the IRA for Part D drugs, for the catastrophic coverage portion of cost, which essentially all the cost of the drug after the donut hole, payers used to eat 15% of that catastrophic portion. Now it's 60%. And again, this is for the half of Medicare patients that are not Medicare Advantage, but that's a huge change, right? I mean, if you're talking about a drug that's $100,000, I mean, the liability could go up, $40,000, right? And so anyways, I just think it put my radar up. Skorney, do you have any other thoughts? I mean, how when you're kind of looking at this yesterday, what do you think about Neurocrine, and do you have is this raising your eyebrows too, just like more broadly about payer dynamics changing this year for certain types of products?
Yeah, so I mean, I guess I would have a slightly different take. I kind of thought the number that they printed was fine. I mean, it was slightly below consensus, but I think in line with expectations. I think it was really the guidance, as you brought up, is what people are freaking out about. And it's funny they gave 2.5 to 2.6. If it was 2.6 to 2.7, I think the stock would be fine. But it's just and you brought it up with them on the call. It's just kind of that change from like a 20% growth to a sub 10% growth. I think people would be okay if it was like teens growth. So that is the big question. There are a lot of factors going into this year in terms of changes. Obviously, the Part D redesign. When you look at all the large cap companies talk, Bristol actually, I tell everyone to like go into Bristol's slide deck. They really went through in a lot of detail what they think the initial catastrophic coverage costs would be on the redesign for like Eliquis, which I think is a not as expensive, but a reasonable comp to try to understand how this could potentially impact those exposed to it. I always kind of think it's funny every time I do a follow-up call with Matt and the team. They give me reasons why I should be more conservative on numbers, but then they classically, have wound up beating and raising throughout the year. And I do think that's an interesting dynamic. I mean, clearly there's payer pushback with this catastrophic coverage. One of the things I know you were there for our JP Morgan meeting, Paul, but I was asking them about, okay, but what about the erasure of the out-of-pocket costs for patients? Does that drive utilization? And I think that's the big question, right? So one could argue, are payers being tougher here because they see the potential for utilization to really grow in a lot of these markets because the out-of-pocket costs for the patients are much more limited. And that's kind of a back half of the year question. No, there's not many companies who are really committing to saying, oh yeah, like utilization will really increase, and we'll have this front end loaded hit to revenue, but in the back half, maybe it'll really see a shift in terms of utilization. So it's just something we'll have to watch out for. I'm not, I think it's obviously an overreaction to see the stock where it is, given they also have a nice launch in Crinecerty. But that's sort of how I view it.
Great. Tim, do you have any comments on any of the topics we've been talking about before we move on?
No, I think we've had a good, robust discussion.
Great. So one other thing that caught my eye this week was this merger of two companies that at the end of the merger, they're going to have over 700 million in cash. And some commenters were asking why not just return the cash. And this is Alumis and Acelerin. Brian, I think you were covering this, or you had some comments on it. Can you comment?
Yeah, sure. So I cover Alumis. I'm familiar with the Acelerin. I cover Amgen. So I'm very familiar with the thyroid eye disease indication as a whole. And yeah, I mean, it was a pretty busy night last night to begin with. So to have this was kind of a bit of a shocker. And I mean, I don't know if Tim has any knowledge of the history of transactions, but it's a pretty unique transaction. I don't really recall ever seeing this sort of two companies with decent balance sheets, one much bigger than the other, merge and combine cash in such a way. From the Alumis standpoint, I kind of highlighted in my note, you're looking at a stock that's $6 and change yesterday, just about a $380 million market cap. They're bringing $400 million in cash, issuing 45 million shares. I mean, it's almost their full share count in issuance. But if they try to do anywhere near this size of a financing through a follow-on offering, I mean, there's no way they could do it anywhere near the $6.50 price. They just probably couldn't do it. I think there would be restrictions on 100%, near 100% dilution. But if you do the calculation as if they were doing this as an offering, it winds up being like a $9 per share offering. So I think it's very beneficial, certainly from the Alumis standpoint. It gets them a wealth of cash that gets them through a number of catalysts. And one of the big problems that I hear talking to investors is they just don't have catalysts until 2026. And we've seen sort of these companies that see balance sheets dwindle quarter to quarter. They really get in kind of this death spiral. And I think this offsets that. And it's definitely unique relative to other transactions to raise money that I've seen.
Just to comment a little bit, of course, I was not aware of this particular deal, but it reminds me very much of the merger of EQRX into Revolution Medicines. And you may recall that at the time of that merger, everyone was sort of saying, like, why is EQRX giving Revolution Medicines their capital? Wouldn't it be better to return that money back to shareholders? After all, shareholders know what to do. The reality is people at EQRX were very smart, right? So Revolution Medicines has done really well. It's been a great transaction for those shareholders. And if you look at this situation, what you see is Alumis has two very expensive clinical programs. They're going after psoriasis and lupus. I mean, those are not cheap areas. It reminds me of the previous comments on migraine. And so with the capital coming from Accelerant, I think there's an opportunity to really supercharge Alumis. So I view this as kind of almost like a capital raise for Alumis. Of course, Accelerant does have some good stuff in there, and hopefully those will also see the light of day. I should mention, I commented before that I saw M&A, being pretty robust. And one of the reasons is I've been aware of the Bain Mitsubishi Tanabe transaction, and that transaction was literally announced as our hangout kicked off. So I see it on hitting Endpoints News at 11:06 this morning. So just very fresh transaction. And so Mitsubishi Tanabe has just been sold for $3.3 billion. And, hats off to Bain. They're picking up the rights to Radicava, which has potential to be $1 billion drug for the treatment of ALS in the U.S. So it just to reiterate, it's going to be a pretty interesting year for M&A based on what I'm seeing. That was one of the transactions I've been aware of.
Oh, that's a great update. I hadn't seen that. So, Brian, Amgen recently launched a biosimilar version of Regeneron's Eylea, and looks like they generated about $31 million in sales in the last quarter of 2024. How is Regeneron reacting to this? Any thoughts on this, the dynamics between those two companies?
Yeah, so I always tell investors these guys are sort of arch nemeses in the biotech space. They have a lot of overlap in multiple areas. There's been an ongoing battle in the PCSK9 space, both on the commercial front as well as the legal front. They certainly don't have the nicest things to say about each other. So it's very interesting that Amgen, amidst a range of other biosimilar producers who have targeted Eylea as a biosimilar, is really the only one that's successful in getting an approval and then subsequent launch after a legal decision late last year. And they're on the market with Pavblu. That's the biosimilar, and there's a lot of nuances in how they sort of got around the IP that the other companies that have filed biosimilars have not been able to do so far. But Regeneron stock has really taken a very significant hit over the last 6 months or so as a result of both this and a bit of a slowing down on the launch of the HD Eylea, which is the high dose version of Eylea that Regeneron's trying to get patients to switch to. So it's very interesting to me. Regeneron, I think, is one of the more colorful management teams. Len and George being the founders and running the company for I think it's 30 years plus now at this point. And they are certainly very opinionated guys, as you all know. And interestingly, Regeneron kind of, with their earnings this week, they kind of reached a point where I was like, oh, this is really a maturing company. They announced the issuance of a dividend. They announced that they are increasing a share repurchase program. Something that you really see kind of larger, profitable pharma companies doing. And there's been a big question as to what Regeneron was going to do with this big cash balance that they've sort of generated. They're sitting on about $18 billion in cash. So very unique position with very little debt. I think that was a very positive signal. And then it was very funny. People just kept asking questions about the Eylea dynamics, and it frustrated the CEO, Len, so much. He basically said, stop asking questions on Eylea. I think a Bank of America analyst came on with a question about Eylea, and he pushed her back in the queue and said, we're not taking that question. It sort of got a lot of humorous emails from investors at that point about sort of the dynamic of showing maturity of issuing a dividend and doing a buyback, but then simultaneously telling all investors, don't worry about like your most profitable product. Let's look at the pipeline, and that's what you should focus on. Then Amgen reported 31 million in Pavblu sales. That's in 9 weeks into launch. I think that's a pretty impressive number. A lot of feedback over the years in the ophthalmology space was that biosimilars wouldn't really take that much of a hold, and there'd be this sentiment that you would want branded medicines that are expensive and have an potential ASP plus 6 benefit for ophthalmologists over cheaper alternatives, but also having less frequent injections. It seems to have turned a little bit, and it certainly seems, even from a Regeneron standpoint, that they're a bit threatened by the Amgen Pavblu launch, and Amgen sounded quite excited. So it's interesting to kind of watch these two guys go at it in Regeneron's sort of core focus.
I mean, just to add to that, Eylea is a $9 billion product. So biosimilar entry that is successful is a big deal. And, most people don't remember, but one of Biden's initiatives way back at the beginning of his administration was to make biosimilars reimbursed at ASP plus 8. So if you get your pricing right, you can actually create strong incentives for ophthalmologists to switch to a biosimilar, which I think obviously is something Amgen's figured out. There are a lot of other Eyleas that are in development as well, and so we should expect to see the Eylea market become ever more competitive in the next couple of years.
Yeah, one of the things that's fascinating to me, you touched on this, Brian, this idea. I think broadly we talked about management and what sort of builds credibility, what destroys credibility. And, you talked about, on the one hand, guiding conservatively. I think it was Paul mentioned, or maybe it was you, Brian, that guiding conservatively then builds credibility, and the management tends to outperform. Then that's comforting to you. Companies not saying nice things about each other. I think that's one that's fascinating, and also being defensive and shutting down questions. That's also really interesting. I'd love to hear from Abe and then others. Just this whole concept of management credibility, things that really destroy or build credibility. But in particular, I think this idea of being defensive and also bad mouthing your competition is one that's always been interesting to me. Abe, do you have any thoughts on that?
Sure, and I would agree with kind of your kind of overall outline of that. I think, guidance and the conservatism yet realistic guidance is something that I think always builds credibility with management teams. And obviously, that takes on a bit of a different tone when you're guiding towards, call it development milestones, as a purely kind of R&D stage company versus commercial milestones, because commercial revenue, prescriptions, et cetera, are a bit more accessible to the audience, the investor audience, than what's ongoing with development. You really are the holder of that information. So I do think that one of the biggest challenges that we've seen in many organizations as they go from R&D companies to commercial stage companies is actually preparing for being a commercial stage company as a management team, and how you have to be able to effectively guide commercially, which in my opinion is just different from how you guide from a development perspective, because there's so many different things that you are thinking about and what you're in control of, and also things such as reimbursement access that you're partly in control of, but we also know that legislation, policy, et cetera, can shift beneath you. I'm a strong proponent of there is no reason ever to talk negatively about another company in your space. It always surprises me when it happens. Quite frankly, I do. Maybe I'm a bit altruistic here that we're all doing this for a specific reason, and that is to one, help patients, and two, continue to provide returns to investors. And talking negatively about other companies in the space just seems to go against both of those things. I think back to my days at Cerevel, and Daphne, you'll know this really well. Paul, you'll know this really well, and us kind of thinking about working with Karuna. And it's interesting now, as you guys know, I'm working with all the Karuna folks now. We always believed that this was muscarinics as a class were more important than the individual programs at the end of the day, because we saw this as a huge opportunity for patients and a huge market opportunity. So it does surprise me that occurs. And then defensiveness. I think at the end of the day, there's some folks that feel that they have the right to push people in certain directions, and it also is a bit surprising to me because I don't think it's beneficial in the long run. But we know that there's certain dynamics that drive that, both on an individual level as well as kind of the history of the company with a given audience as well.
Yeah, maybe I could chime in for a second. And I'm sure Brian relates to this, but I mean, when a management team is defensive, and if you're skeptical on something, I mean, to me, it usually makes me feel like I'm onto something, right? And the converse is often true. I mean, I've launched on stocks not supportive, and the company has been super cordial and excited about engaging. And those have actually often, or at least a few cases I can think of, have been actually not great stock calls for me, where the stock actually did great. And I think the company's willingness to engage really reflected their confidence in what they were doing. I mean, I think if you take a step back, like what I'm looking for as an analyst, and I think a lot of investors are looking for, is that when you ask the hard questions, it's not a gotcha. You just want to know that the company has tried to think of everything. I relate back to another example, Abe. I mean, the Cerebral Karuna dynamic was a good one, right? But I think back to Steve Paul's comments after the first muscarinic phase 2 RCT, where he was really excited, but also said, "Hey, we have to be a little bit cautious here, right? I mean, this is one study. The extrapolatability to Alzheimer's is still unclear." And I hear that and I think like, okay, that's really comforting. I mean, this person's thinking about this as a scientist versus other times, right? When, an early result is framed as, oh my God, we've cured this disease, and now you can extrapolate to this, that, and that. And so I've talked to investors about this too, especially when we talk about the CNS space where trial conduct is so hard, but even just broadly, I mean, I think investors, they want management teams that, of course, can sell the bull case and sell the upside case, but also management teams that convey that they're a little bit paranoid, right, and are going to check every single box to make sure that they don't get unlucky or something like that. And I don't know. I mean, Brian, you and I are both two sell side analysts, right, who are willing to not always be positive. You maybe even more than me, right? I mean, you and I were talking at JP Morgan about this. And what's your kind of experience, right, when you're trying to poke and prod at certain things in companies, and how do you interpret feedback or receptivity?
It's funny. I mean, I think you need kind of a track record with management to understand those dynamics, right? Like, so there would be some CEOs where if they got defensive, I'd be really worried. There's other CEOs where I'm like, these guys are just naturally defensive, and they're always fighting over my comments. So it's not necessarily a read. So, the body language and the tone of management, I think, can be very specific to management. It's always funny to me, the type of management that I like and appreciate and say, oh, this is what I want in a CEO versus, what investors will, right? So I even though there's some management teams I'm very friendly with that are flashy, I kind of hate the concept of flashy upselling management teams. If you ask me, like, who do I want to speak to as a CEO, it's someone who who's very straightforward, kind of presents the bull case, the bear case, and has a good handle on all of those dynamics. But it's not necessarily the same, CEO that everyone else likes. So it is a very interesting dynamic how it kind of takes all kinds, and one CEO is loved by an investor, but another investor can hate that CEO.
Yeah, totally. I mean, I think I agree with you, right? I mean, I think we both have the same kind of taste, and I think just separately, right? I mean, companies need to know that if Brian or I is asking some question that might feel like it's a tough question or might feel like it has some underlying element of skepticism embedded in it. I mean, sometimes it's a question that he or I thought of and came up with in our diligence. Often, other times it's something that an investor is asking one of us. And I think I hear this in Skorney. I wonder if you hear this too. I hear too often companies kind of almost like blindly blaming this concept of skeptical hedge funds or people trying to create narratives as a reason for tough questions or a reason for skepticism out there. And I think that they'd be surprised to know that a lot of folks that are long onlys or even big shareholders of companies are still ones that are asking themselves the tough questions and asking analysts tough questions because that's what makes them a great investor. I mean, I think even if you love a stock in biotech, I mean, it's hard to love a stock and still and ever feel 100%, right? Or even 90%, right? I mean, the stocks that I love, it's often, I think there's a 75% chance I might be right and there's a good risk reward, but there's 25% of me that's still terrified about X or Y, right? Because that's the way this sector goes. And so I think knowing how to engage with that and knowing that most analysts and investors who are asking these kinds of questions are not coming from like an actual place of an agenda. They're just trying to figure it out is probably the best approach.
Yeah.
Yeah, I mean it's science, right? It's a method of inquiry, and that's what the sector is underpinned by. So I think it's no surprise that everyone in the sector should have critical questions. And it doesn't mean you're trying to knock the stock down. It doesn't mean that you're a short. I mean, what it means is it may be that the person's short. It may be that they're trying to find holes, but it could be people just checking their position, right? And look, I'm not an investor, but the best investors that I know who perform the best on a regular basis, they seem to really want to understand where they could be wrong on something that they're long. So convincing, getting them over that hump is very important. So I hate when CEOs sort of take it like, oh, it's the shorts trying to push us back. No, it's not. It's the entire investor base really wants to have all these nuanced questions answered.
Yeah,
Yeah.
maybe just one comment on this. I would agree with many of the things that you're saying, Brian and Paul. And I think, the best place for a management team to be is to, hold the same level of objective skepticism that the rest of the world does, right? That at the end of the day, and I think this might be one of the themes that you're pushing on, Paul, is there's a certain skill and I think a certain pattern recognition that evolves with great management teams that, it's not just understanding what the bull case is, it's also understanding the bear case. But within understanding both of those cases, it's understanding what you're going to do next as a management team in terms of your overall strategy. So, I often find if you think about it that way, you're not defensive, right? Because that's just what you should be doing for your job. And being asked the questions that either push you down one path or the other is just kind of a natural sequence of what we do in terms of scenario planning and understanding what our paths are going to be as a company. But at the same time, that takes time, right? That takes time, both the management team building, the right rapport within the team, but it also really is the relationship that is built with, sell side analysts, investors, really understanding the management team and how they think, whether it's the CEO or the entire team.
Yeah. And I think a lot of these points are also relevant as a CEO engages with the board, because the idea of showing that you're aware of the issues, that you have a plan, and that you're not hiding or being overly optimistic about the issues, I think is really important. Also for the board and for other parties, including the team. And it reminds me of a discussion we were having with Josh Schimmer. He had a name for the CEOs that never want to acknowledge that anything's wrong. He called them the everything is awesome CEOs. So that was pretty funny. And maybe we can find that and reshare it here because I thought it was helpful. But I agree, and I think this is a really good discussion. We often come back to this topic of leadership, credibility, management, the whole interaction between management, investors, and the rest of the community, including, by the way, journalists. So, management teams that are very defensive and get angry at journalists when they write something that's not entirely positive. Also, I think those have negative implications back to the company. So, I think we only had a couple of other news items, and we're getting close to wrapping up. Not sure if any of you guys saw that Hims Super Bowl commercial, but it was really obnoxious in many ways, especially the virtue signaling. They basically they're stealing the work of other companies, selling an unregulated compounded version, and also saying super negative things about the industry, and I think in many ways are very kind of parasitic. The advertisement is promoting the drug with no fair balance. So what happened actually, just I think it was yesterday, the Partnership for Safe Medicines has written to CEDAR expressing concerns over the commercial. So let's see what happens with that. I don't know if any of you guys saw it, but it was really a frustrating commercial. Did you guys see that?
Daphne, I haven't seen the commercial. I would say that in general, um, most people in our industry are pretty skeptical of this compounded market that's crept up in these incretins. I tend to take the other perspective. The compounders are actually very tightly regulated. If you listen to commentary from Nova and Lilly, you would have this impression that there's these guys out there in their garages just whipping stuff up and selling it without much consideration. The reality is it's not only a highly regulated sector, but the pricing of the blends that's available online is allowing access to these drugs to reach a whole nother group of people that otherwise would not be able to access them. So I'm not saying that the commercial is fine. In fact, Hims is sort of obnoxious in general in how they approach people. So I'm not defending them as a company. But my impression overall is that there is a place for this market, and Lilly and Novo have just been going to great lengths to essentially knock these guys out, including using organizations that sound like they're how should I say independent organizations that are actually being indirectly funded to discredit compounding.
Yeah, watch the commercial. They're basically talking about how the drug industry is taking advantage of, patients and all this stuff. You got to see it. Maybe we'll link
Yeah,
to
no,
it.
I'm not defending it. I'm just saying. I actually think compounding's been one of the more interesting developments because it's allowed patients to really go out and get access to drugs online on their own, really for the first time in a major way since our industry's been going like 20, 30 years.
Yeah, we should talk about this more broadly at another time because I think there's some really interesting aspects to this, including like the idea that a company will be investing years and millions, even close to $1 billion in R&D, and then other companies could benefit through kind of this loophole. And I know that it's temporary, but I think it's an interesting topic to come back to. And I agree that there's a place for compounding. And in this case, where the drugs were really quite expensive and they had shortages, there was a reason, there was a rationale behind it. But you just have to see this commercial. Anyway, I think we maybe go around and just do closing comments. Tim, you had mentioned something about Jay Bradner interview with Paul on China or something like that. So maybe you can wrap up with that and any other closing comments.
Yeah, just to give a couple interesting tidbits, Paul did a very interesting interview this week with Jay Bradner. Bradner said engagement with the FDA is business as usual. He is not concerned about the FDA commissioner going wildly, off the case. He said that there's tons of free cash flow and firepower for M&A and big pharma. He said it's really the supply side dynamics. He pointed to CAR T, saying there's, one, it was great to have one good one, and now there was another 200. like, how many of these do you need? He said that Chinese science is going from being non-existent to fast follower to now being really innovative, and sees China as an important competitor. There's a very interesting story also in the journal today about Chinese competition. Those were a couple of the things that came up in Paul's very interesting interview.